Right, cool. So let's start. We have here Dirk Pavel from SaaS Group, right? Our own M&A guys. And then there is Kelley from acquire.com. Super excited to see you here. Thank you for making the time. So what we want to do here is to just go around all things M&A. Probably just the very beginner stage, like when you start looking for possible acquirers, what could be the reasons, what could be the outcomes, what could be the terms, right? So first, I think that the main question that's trending right now everywhere is the market so bad that's now like it's not the best time to sell? What do you think? What do you see on the market, Paul? But you probably have more of a global view on that.
Sure. Thanks for that, Anna. We're seeing so much activity in our market, at acquire.com that I don't see much slowdown, frankly. And as it relates to the PE community, there's still, I think there's still historically an enormous amount of dry powder waiting to be deployed. So, the difference that we're seeing is that I believe, cash is king once again. We were talking about this earlier where, maybe 12 months ago, a buyer group would look at a startup, maybe it was a mature startup, say 3-4 years in, it clearly found their product market fit. It's a great addressable market, and they've had year-over-year growth, although they're not throwing any, net profitability or EBITDA to their bottom line. Although it's there, it's just ready to have, high octane fuel poured on it, and private equity would take looks at that all day long, and they would do multiples off of that top line. Whereas now I think that they're just being a little bit more cautious for the downside risk, and looking for that cash flow, at least some cash flow to cover their basis there.
Okay, yeah, makes sense. And Pavel, I think you were talking about the fact that there are less and less bootstrapped founders, bootstrapped SaaS companies that you see that come basically to talk to us.
Yeah, I think what we notice in the last 12 months is that there are probably less companies that I would say that are sort of on the edges. So the companies that have super cool technology and trying to sell for massive valuation, you see probably those companies delaying the sell decision to maybe a better market when there's a bit more certainty about the interest rate raises, etc. I would say that there's always a good time to sell your bootstrap SaaS business if you're growing, you're very profitable, you're very lean, have a very good product. But we are seeing a lot more founders, particularly from the United States, delaying a decision to sell. Perhaps they kind of watching the news, they're worried about kind of what's going to happen to the economy, and they also expect the buyers to perhaps to offer less. At the same time, in Europe, we are probably seeing a lot more interest to sell, and I think that's because there are a lot more, relatively speaking, proportionally speaking, there are a lot more companies that have raised capital 5-10 years ago, have sort of operated at a break-even or slight profit, and now they realize that it's time to sell. So it's more of a timing pressure.
Yeah, if I could kind of dovetail on that, and you're spot on there, Pavel. I think really understanding first, have some self-reflection. Why are you even considering it? Why are you selling? That is a huge determinant factor on the plot. You're plotting your course forward. If it's because, as we at our company, we speak to so many startup founders, and just the DNA of the startup founder is they're always hustling, and a lot of them are working on the new shiny thing, right? So their focus is detracted from what has gotten them there in the first place. So that's a reason. That's a good reason, and then you could use that capital to invest in the new opportunity. But really reflecting on why are you selling, and being real with the market, and that's what we are with our new product offerings. What we're trying to do, and hopefully we're going to be doing dozens of deals with SaaS Group on an annual basis. But we're really setting up founders for success, and we're giving them that reality check. And that's from getting through our onboarding process to, we have scorecards before we even go live. It's like, here's where you're deficient, go fix this, so we really help them set up for success and also get them a major reality check. And as the adage goes, do you want to hear what you want to hear, or do you want to hear what you need to hear? And when you have factual information, that is the best way to make those educated decisions moving forward. So I think really understanding why first is the most important.
Right. And I guess here, like the next logical question would be, what are founders looking for, right? So are they looking for mostly to just sell the company and go build the next shiny thing? Or are there more and more founders that kind of want to take the risk off the table, like say, I don't know, like Taplio did, right? They, I think their deal now is they're on the earnout. So back me up with the terminology here. So they're still going to work at the company for a while, for 2 years. I think that's pretty normal, right? So they want to take the risk off the table, but they want to still grow the company with the resources that private equity, for example, is willing to give them. So Dirk, maybe you can chip in here, because you're usually the first touch.
Yeah, so I think a lot of founders, if they hear the term M&A, it's more like they think of it like an exit path, but it can also be an opportunity to like just take some chips off the table and grow with a certain partner who has maybe more resources, who has domain expertise or whatever. So if you find a good partner and you think, okay, that's a great new home for my business, I think you also should put trust in these people to help you grow the business to the next level. And so, yeah, I'm always surprised that most founders I talk to, they just want to get out if they are talking about M&A and if they talk to us. But it can also be an opportunity to, again, collaborate with someone and benefit from that upside you achieve together. So I would recommend to like also consider options like this, maybe a longer earnout period, or maybe keeping some shares, or if you think the larger group has more firepower and can get to a higher level, maybe even consider an equity swap or something.
That's right. And then also, remaining open-minded through that process, because you don't know who the buyer is going to be when you start. You don't know what the structure is going to look like or what those structures presented you are. We always, and I think you touched on this. Did you give MyWorks as an example? Did I hear you right, Anna?
I didn't mention it, but you can give a bit of background.
Oh, I thought you were using that as an example. That was a scenario where we actually transacted that about a year ago, right?
Yeah.
And it was a client that was, we started working with, who was always worked for himself, true startup founder, bootstrap, and just did a fantastic job and built a great company. Got married, had a kid, and when that first meeting happened, I always ask, why? Why are you selling? Why are we talking? And it was my favorite response is that I want to spend more time with my family. I'm missing it. And so that was the perfect answer. Then that stage, we go into the box of, okay, here's what the process looks like, explain the process so they get fairly educated. And then I always talk about, what possible deal structures may be presented. If somebody hears earnout or a contingent payment or seller note or deferred payments, any of that in an LOI or IOI for the first time, it's almost like a curse word, and they'll just immediately kind of look at it in a negative light, whereas it's not always the case. But using the same example as that company that you guys acquired, when we first started talking to him, and he said, I don't think I can work for anybody else. I just would rather just, sell if there's a transition period, sure, but I'm not interested in that. I want to still be my own person. Well, after going through the process and meeting these guys, that changed entirely, because he saw the vision and he saw the growth and he saw the opportunity ahead. And I still speak to him, not as much as we should. We've just given each other a hard time because we've been threatening to get together. He's in Texas and I'm in San Francisco, but he's happy as can be. And so that is the perfect case study of, starting at point A, no way would I ever work for anybody else, to holy Toledo, if I missed that opportunity, I would have just been missing the ball entirely. So keep open-minded.
Yeah, I mean, either you can have like something in mind already before you even run a process. So if you know, okay, you want to start something new, or you already started something new, you're working on, and you want to get rid of your old baby, then okay, it's fine to like propose a deal structure where you, for example, don't have a large earnout component or long transition period. But you can also, as you said, be open-minded, go in the first conversations with buyers, and if you see, okay, these are nice people and you could imagine working together with them for longer, then yeah, maybe it makes sense to have a longer earnout or a larger earnout or a longer transition period.
I actually have a question, if I may, for you, Dirk.
Yes.
When you have that first founder call and they indicate to you that, yeah, we just, pay us cash, we want to be out the door, is that a red flag for you at all?
It depends. I mean, sometimes you need a second call to really find out what's the reason behind it. And sometimes there's a reason because there's a certain business risk, but if there's not a certain business risk, it's on us to find out what's the actual reason. If they started a new business already, okay, that's a very good reason. If it's, yeah, I don't know. If they can't really like grasp it, what it is, and they want to get out immediately, then it's at least an orange flag, and you have to dig a bit deeper to find out. Yeah.
Thanks. Thank you.
Yeah, makes sense. And I think it's great that you mentioned like post-acquisition, what happens there. And like you said, there is probably not too much information about that. For a lot of founders, acquisition or exit means exiting completely, right? And like going out of that particular business. But there are a lot of other different options. So next question would be, I think, about like how to approach it overall. Like, how do I go, if I even start to think about an exit, how do I dig into that, and how do I ask potential acquirers, like, what could be my options? How do I build that relationship? Like you said, sometimes you're going to work together, and even if it's not an exit, even if you don't have an earn-out option there, you're still going to work together for some time, right? It's maybe 2 months, sometimes it's 6, right? Because you're in a relationship with these people. So how do you want to go out and start basically dipping your toe into your options without appearing like you're window shopping and you're not really serious about that? Like, how do you build how do you make sure you're kind of aligned with the potential acquirers that you may sell at some point, right? But you just are there to like find the best option.
Shall I?
Feel free.
So that's what we do all day long at Acquire. So we really help, I would say, to answer that question in a nutshell, go get educated first. Learn about the process, learn about what's going to be expected, learn about what buyers are going to want to look at. They're going to get under the hood of your business. Make sure that, your housekeeping is in order. And that means, creating a proper memorandum for your business, or at least being able to speak to the business in content form so you can share it with potential buyers if you get there. Do diligence on yourself as if you were the buyer. You don't want to, if there's surprises or things you need to fix, rather you do it then before you go to market. Often there's the, 4 or 5 years in, we all know founders, they have blinders on. So they're just doing what's in front of them, the extensive list in front of them. And so if you're not prepared and you get on a first buyer call and they ask you about some specific KPI or customer churn or tech stack, something or other, and you don't have that answer immediate, right or wrong, your business has just been devalued. You might have the answer, it might be there, but because you didn't, it's a perception of a lack of organization that reflects on the business value. So we always are just, get educated, prepare your business properly, and be ready. And I've used the analogy of when I was training for my first marathon years ago, and a buddy of mine that was very experienced said, man, just put in the work, put in the road work, put in the miles, come race day, be a breeze. And the same analogy is used here, right? So do the heavy lifting, put in the road work, get your house in order. And then when it comes race day, when you're ready to go live, you're going to be in a much better position.
Right. Okay. And Pavel, maybe you can help me out here a bit. So, and this is something that I also started to look into a bit recently. So, due diligence, right? We talk about due diligence, what we want to see from the founders, from the startups, but it goes both ways, right? So, what's a good kind of process? From the acquirer side, what should founders be looking for when they're approaching somebody who wants to buy them?
Sure, it's a great question. Before I address that, I just want to maybe for 1 minute to complement what Paul said.
Sure.
It's important to remember that when you approach different buyers in the market, those buyers, just like SaaS Group and any other of our competitors, we all have a funnel. And what it means is that we can only look at a certain number of acquisitions every month, every year. And as Paul mentioned, that sometimes when we see a company that is unable to provide you like very basic information, that's immediately sort of a red or yellow flag, because that just means that, okay, we have 5 other businesses in our pipeline that have good metrics, everything is on Stripe, accounting is on QuickBooks, etc. Right? So it's really important that you at least come prepared, because for a lot of the buyers, especially the ones that have a lot of deals in the pipeline, they may simply disregard your business because it doesn't stand out from a large number of different businesses. So that's kind of to complement. As for, I guess, what you need to look in the acquirer, I think unless you are working with a advisor or platform like Acquire that will guide you to what sort of different buyers exist in the market, it's just important to do some research and figure out who is the best buyer. So we at SaaS Group specialize in acquiring primarily product-led growth SaaS companies that sell primarily sort of AWS hosted software subscription model, process their payments through Stripe or a similar platform if it's in Europe. We are less sort of focused in the enterprise software, as an example, where, for example, companies like Constellation, Banyan, or Valsoft are more active. And so it's important that you spend your time talking to the people that understand your product and understand your challenges, and that could help you not only find the best structure and valuation, but also, as Paul said, that in that process you may even discover that instead of leaving the business after 1 month, you may want to stay for a couple of years, because you actually realize there are people that, just like yourself, they're very, very passionate about growing the business. And perhaps you want to spend a couple more years learning from those people, exchanging the knowledge, and maybe even get some upside in the process.
I wholeheartedly agree with that. And, as you said it, I was thinking of numerous examples over the years. I mean, I've been at this for over 20 years, where I've engaged with clients, started doing the memorandum and getting ready for going to market, and just punching you in the face is all of this low-hanging fruit. And I've recommended, gosh, if you just did X, Y, and Z over the next 12 months, this would be a substantially higher exit for you. And by the way, you're going to create way more interest. And so I've talked myself out of deals in the past, but that is, you could do that on your own. I've seen founders do that when they start getting into it, and there's a reinvigoration. They're thinking about the business differently than they were yesterday because they were just doing the list. And so that's exactly right. So it is, and that's all about educating yourself and getting prepared. It all is in the same nutshell there.
Okay. Well, thank you so much. And I think from that question, we could easily go to the next one. Also, in the same area, I'd say, about culture. And this is something that a lot of founders started talking about. This is some kind of a trend. Maybe acquire.com started it, because I've seen a lot of the posts of Andrew talking about that. So how important is it really to be acquired by a company that understands your culture? Like, could it be, I don't know, adopted to another? And I don't know, like, how many founders do you actually see that say, I care what happens to the team, and I care what happens if I just want cash, I want to go and build the next thing. I don't want to stay with the company. So if that's the case, what's the role of culture of the acquiring company?
I think it really depends on, sorry, go ahead. Okay, good. So I think it depends on what you want. I mean, I met founders that were not caring at all about what happens with the company post-acquisition. So in this case, I mean, you can be quite open and it doesn't really matter. But we also talk to a lot of founders that want to stay on board for longer, maybe a year or half a year, and also want to find a good new home for their team, not just the product and everything else. And so I think it's really important and your responsibility as a founder to find the right buyer where it fits culturally with your team and where your team gets integrated properly, and maybe also kind of hand-holding in the beginning. And so, yeah, I think it's one of the top 5 priorities, I would say. And it also depends on the team size. I mean, we are also talking to many founders that just have a team of 3 to 4 people, and some of them even just freelancers. But we also have teams with 20 people, 25 people, and there it's even more crucial, I would say.
Yeah, and I'll speak to that a bit. Where I mean, everyone's heard me say it a million times that the importance of goodwill in a transaction, and that's part and parcel to what you guys are talking about, right? So right from that first meeting, and you'll know in 5 minutes if there's a not a fit, because this oil and water sometimes. But really, that goodwill portion of it is super important. If the goodwill is being built and you're still maturating that goodwill all the way through a transaction, when you run into hurdles and there's price adjustments or something, as long as everyone's working in the same direction and there is that level of goodwill and relationship that's been built, it just makes those hurdles, so much easier to get through, because you're all working towards the same goal. And then as far as the ethos and culture inside of an organization, I think if the moral compass is aligned, I think people can learn to integrate into that culture. And so again, goodwill.
Yeah, I would also add that it always puzzled me, why do founders care about like what we do with the business, or why do we care about the culture? Because I thought always that for founders, at the end of the day, it's all about the price, right? You want to have the best deal possible, because you walk away and kind of everything stays behind. But what I also realized that price is very often dependent on the cultural fit, right? Because if you are acquiring a business that has perhaps terrible culture, that could imply that you have to replace the people later, and that could mean a price cheap, right? And we at SaaS Group, we had unfortunately cases in the past where we had some founders that we really liked the business, but when the due diligence, we realized the culture was way too different, and at that time we kind of choose to walk away, for example, because again, we don't want to have a lot of people in our business that are not aligned to our values. And because we have a lot of cooperation, like DevOps, product, marketing, etc. And if we don't have that cooperation, that means we as buyer cannot get maximal value out of business. That means the price is not there. So I would say that choose the buyer that has a similar culture, that is happy to keep your staff, because you don't want to go through a lot of redundancies and stuff like that. And just make sure. And also for a lot of buyers, it's important that the business that you have built over the next 10 years is still there after 10 years, right? Because people care about that. They want to talk about it to their friends, to their family, and it's just something that's close to their heart.
Yeah, and I would also add a quick side note. I would always advise to just talk to as much people as possible within the potential company that will acquire you. So we, for example, offer that as part of the process to talk to our founders, to talk to people from the central team. And as a founder, I would always require it because I'm usually the first point of contact at SaaS Group, but I'm getting paid for like drawing the best possible picture of SaaS Group, right? So I think it's important to also show who else is working for that company and are these the right people to take care of your baby.
Yeah. Oh, that's something that I noticed because I also talk with a lot of founders and obviously all of our founders. And it's something that I noticed when I was talking with them. Anytime I would drop a name of another founder, they would say, "Oh, I know him. I know him. I talked with him like last week." So it was really cool that everyone knows each other, even though, you know, we've never seen each other ever. So we've got a first question, and Leticia, correct me if I don't understand it right. So any recommendation for businesses offer a great opportunity, but they have a low ARR?
I think it's a question for Paul, perhaps for the acquirer.
Yeah, sure. Go ahead and ask it.
Hi, just to give you a quick pitch about me, my name is Letitia. I'm the founder of Olabrief. It's a SaaS tool for creative agencies to basically get the ball rolling with the clients. And we've reached a point where considering exiting. Earnout has been a thing that an option that we've been discussing with my co-founder. However, our ARR is not shiny. It's not very good. And that's the first thing that people obviously ask for. So, but obviously as a founder, and I think you guys mentioned before, it's our baby. So we think it's fantastic and it's a great opportunity. So if we don't have a fantastic ARR, what are other things that we can kind of use, or not use, but sort of shine a light on the opportunity that our business might be?
Sure. So I would first ask you, why are you considering a transition?
To give you some background, so I'm from the creative world, so a graphic designer turned founder. Very steep learning curve, violently steep. Yeah, and as a creative person, we've been doing this for about 3+ years. We basically put everything into it. There's a community, there's clients, there is some understanding. So there's some IP, but we've reached a point with myself, with my co-founder, where we've plateaued. It's not our natural zone for the next stage of the company to scale. There's not so much we as co-founders can bring more to the table. We need someone else to kind of make our baby fly.
Well, I'll say thank you for that, and first say congratulations for realizing that, and that's important because a lot of founders don't but you're here talking about it, so congrats nonetheless. I think that there's a great story there. You have a non-tech person building a SaaS entity, platform that is ready for that high octane fuel, right? So allow you to do what you do best and what you really enjoy is get back to the design and the creative. And there's a great story there, in my opinion. You've already proven it for somebody that doesn't know, and you've gotten this far. If somebody does know, what can they do with this thing, right? So there's a lot of opportunity, and it's a matter of how you present, how you how you craft your narrative around the opportunity. So I would suggest syncing up paul@acquire.com. I'm happy to run through the business with you, and we have scorecards and all kinds of fun stuff to really set you up for success. And as I think Dirk or Pavel mentioned earlier, sometimes you'll see that, okay, right now is not the right time. And I have this conversation daily almost. But if you did these things over the next quarter or 2 quarters, come back and you'll be super ready to go.
Okay. Thanks so much, Paul. Appreciate that.
Okay. All right. We got some help live. That's awesome. Okay. So yeah, another question, I think a bit more about the process, right? So again, something that a lot of people are talking about. Dirk, I think I saw a few carousels about that. So everyone talks about starting from the beginning, right? So build in with an exit in mind, right? So how do you prepare what are the first few things that you absolutely have to have if you ever are looking into the exit? Anybody? Pavel, maybe?
Well, if you are, I guess, looking to sell your company, just make sure that you actually have a business that's possible to sell. And you probably want to make sure that basic things like the IP belongs to the company, the source code is clean, and everything is working in order. And whether you're doing an asset deal, everything kind of sits in the right legal entity. You figure out the tax situation, because you don't want to have sort of a tax surprises down the line after you start discussing. So I think once you have that, everything else is probably solvable, right? If you don't have the IP, or if you use sort of a code that perhaps was taken from somewhere else without a credit, I think that could really, really have a negative impact on your sale process. I would say that when it comes to sort of numbers, HR contracts, everything else can be fixed during the sale process. Especially, for example, if you're in the US and you have an LLC structure, then even not having an employment agreements or things like that is possible to solve during the acquisition process. But a lot of other things might take a little bit more time, so you don't want to discover that kind of at the last minute.
Okay. And what about, and this is something that we also stumbled upon in my previous company. So that was an open source platform where, you go and build your product and it works. But a lot of founders were kind of shaky on the fact that it's open source and like, how is it going to work after if we're going to raise an investment or maybe sell. So what do you say about using this kind of third-party platforms or any kind of tech?
I guess we at SaaS Group don't have experience of buying open source projects. We did have a few of them in the pipeline. I would say that there are definitely buyers in the market for that, and you'll probably want to seek some legal and some technical advice before coming to the market to try to figure out, is this really the business that can be sold to a third party? How would it be operated? What would happen if the owner changes? So I would say it all depends.
Okay. As always, that's that's my favorite answer. It depends. Paul, do you have experience with this kind of companies?
Learning the hard way, yes, where there's been, that third party tech was discovered, well into diligence after an LOI was accepted, and you then get into the agreement with that third party vendor and they have to approve the transfer. And it's just, you need to control your IP and your tech in order to really have a valuable asset to transact, in my opinion.
Okay. All right. So what are the metrics that founders have to look into and they have to present? So like Letitia, for example, mentioned, ARR is something everybody's looking at, right? But what else? What should also be there on the first call when Dirk's there with you? Dirk, what do you ask?
Let's take turns saying
to be completely honest with you, I'm usually a bit hesitant to ask numbers questions in the first call because it's more about, the personal reason for a sale and stuff. So it's more about, get to know each other and see what's behind. But in the second call or as a follow-up, we usually ask for metrics. And that's typical SaaS KPI. So we want to see customer and revenue movements like new MRR, new customers, churn, upsells, downgrades. That's what we want to see. Based on that, we can calculate everything else. And then, of course, proper financials, so proper P&L statements. I sometimes still get sent Google Sheets with just 2 lines of numbers. We would love to see a bit more, but it doesn't have to be a list with every account. So, you can just Google SaaS P&L and you will find a few good templates.
Or go to acquire.com. You guys have a template there, right?
not a template, a university education. I mean, Andrew has
Sorry.
created videos for every little step of the way. So literally, you can go and find content and videos on pretty much every step. But yes, as Dirk was saying, that all of those metrics on churn and cohorts and all of that, super important. But also understanding what is where are you at in your stage? What's the total addressable market? What's the competitive landscape look like? That's important. I mean, is it super crowded? Are you one of a million, or are you one of 5? That's a big difference. So, I mean, we see them trade all day long where there's just, solid API that, it's a buy versus build strategy, and somebody's happy to take that on and drop it on top of their stack.
Yeah, and
Okay.
I would see it as an opportunity to impress buyers. So not just send what they are asking for, but just prepare everything already. If you think, okay, now it's time for me to exit. Because I mean, if I get sent like geo breakdown of customers, cohort data, revenue data, etc., and everything is like well formatted, etc., yeah, makes a completely different impression, a better impression actually. Then you would just, yeah, as I said, send me a 2-liner of a Google sheet which shows the P&L, which just shows ARR and then EBITDA or something. Yeah, so I think you should do the house cleaning before and prepare everything and then send as requested.
And under those
Absolutely.
two examples Dirk just gave, the 2 lines of whatever metrics they're adding there, that company might very well be worth a ton more, but it's not going to get the looks because of the lack of preparation, and the other business you mentioned is going to be more attractive.
Yeah. So yeah,
There's a
you
question.
always create a. Sorry, go ahead.
There's a question from Aris. I think in contrast to the red flags, what are the main green flags? So I think it's kind of goes into nicely this discussion. I would say that if I only had sort of 5 minutes with the founder and looking at our kind of what we buy as SaaS Group, right? I think one of the first questions we would ask is what's your net dollar retention? Because that already tells you a lot how sticky is your product, right? Are you more like enterprise-like with 100+, or are you more like a B2B2C where there's a lot of reoccurring usage, but your net dollar retention is more like 50 or sometimes less, right? And secondly, I think it's just the historical AR, CAGR, and your profit. And the reason why you need to know that is because you want to first of all know, is the business growing? Yes or no? Is it a sticky product? And then third, is it a profitable product? Because a lot of buyers in the market, they look for SaaS as something that's very profitable, can generate a lot of cash flow. And I think that if it's a profitable business, is growing, has high net dollar retention, that already kind of has alert like very, very attractive business. Of course, I mean, you sometimes have businesses that are maybe not growing, declining, still have high net dollar retention. We're very happy to look into those, but you do want to emphasize those things in one of the early conversations. And contrary to the comment, I mean, the best LTV, sometimes, for example, for us, a very high LTV could be a red flag, because a very high LTV means it's an incredibly sticky enterprise product with a 2-year sales life cycle, right? And there are other buyers that could be better for it. So again, emphasize the metrics that are attractive to a particular buyer. So if you're selling to an enterprise acquirer, emphasize high LTV, high net dollar retention, the stickiness, show your customer list, right? If you're selling to a PLG acquirer like SaaS Group, focus on kind of newer MRR growth, profit margins, remote team, and things like that.
I think besides metrics, I would also add that for me personally, it's always a green flag if the founder tells me, yeah, my team already knows that I'm trying to sell the business. I already have hired some managers years ago or promoted someone from the team, and they can take over. So I became obsolete anyway. So I think that's also a green flag for us because we know, okay, we don't have to hire a replacement post-acquisition, and we know, okay, there's a new management team in place already. So yeah, I would also see this as a green flag.
Yeah, that's something I've heard a lot on the podcast. If that was a guest whose company has been acquired before, that's what they were saying. Like they start to prepare and get ready for the acquisition, and the first thing they do is they get a person that would take over when they're gone. And I think that the same answer goes to our pre-revenue acquisitions common, right? Depends on who you're selling to, who you're approaching, right? Okay, so there is another question, and it goes back to the metrics and to the analysis of the whole business. Could you give maybe some actionable advice and like what kind of services it's good for you to see when you're analyzing the business? Would it be easier for you to go into Stripe, Google Analytics, QuickBooks, or is there anything else you prefer?
Okay, let me take it first. Yeah, so I think if we're talking about, let's say, a US seller, then typically vast majority of US PLG SaaS companies run on QuickBooks. And so having a simple P&L and balance sheet extract for the last 3 years is a good starting point. Ideally on an accruals basis, but we know that in the US it's typically a cash basis, which is not a big issue. Stripe access saves a lot of time because a buyer like us can plug in Stripe into our own data warehouse, and then we can see kind of the upsell, downgrade. We can recalculate the MRR ourselves, which saves a lot of time. And then on the marketing side, you would probably want to have a properly set up, Google Analytics, Google AdWords accounts to make sure that we're able to diligence your marketing tech stack. So I would say that with these kind of 3 categories, you pretty much cover 90% of the business. And then, of course, depending on the stage of diligence, we would go into tools like Figma, Hotjar, Intercom, review the outstanding tickets and things like that. But I would say it starts with kind of high-level KPI, like revenue, top of the funnel, and then the MRR billing.
And the recurring revenue customers is the golden goose egg. I mean, that's super attractive. But can I go back to the comment around the transition and hiring somebody? So, I'm the founder, I'm the key employee. I'm going to go ahead and build some infrastructure there, hire somebody to come and operate it. So when I do transact, I'm not going to leave the buyer with a shortcoming there. So it really goes 2 ways. So if you're willing to stay through a transition and you're open to that, given it's the right party and there's the good relationship built and so on, hiring that extra person might do you a disservice. Whereas if you're just looking to sell, and transition as quickly as possible, that makes great sense. But if you're willing to stay, you might be creating some redundancies, and then you're gonna have to let somebody go, which is not a fun feeling. Would you guys agree?
Right.
Yep. True.
Yeah, I think we actually bought 2 businesses, not going to give names, where we were given the keys to the business, and within a month, I think it was a single founder businesses. So we actually can do such acquisitions, and we would like to see more and more of them. But just as a caveat, that if you are a single founder business at a 1 million AR or more, the chances that your product is in maintenance mode is probably close to 100%, right? So there are a lot of companies like that. We're kind of happy to look into them. That's not necessarily a red flag, but it also does reflect that those businesses are perhaps, there's only one founder there for a reason. There's no team behind it.
Yeah. Okay. Well, thank you. Thank you for that answer. Okay, so maybe we could go a little bit into like possible structures of the deal, because I think we touched upon that a little bit in the beginning, that not a lot of founders know what kind of acquisitions there are and what they could be looking at. So could you maybe talk a little bit about maybe the most popular ones, let's say? Like what do founders want when they approach you, or what you could offer?
Are you asking me or one of the guys?
Yeah, Paul, go ahead.
Okay. So early on in those initial calls, as I said earlier, we like to introduce certainly educate them on what a process looks like, what they're in for, but also what our kind of common deal structures to kind of get educated and versed up on. And I always, will bring up the three, which is, the cash at close, and then some form of seller participation in the, like a seller note. That's effectively, I'm buying your business, Anna. It's $1 million. I'm going to give you $500,000 cash at close, and then the remainder I'm going to pay you over time. It's an interest-bearing loan, just as if you were the bank. Yeah, you're the lender. And then there's a third component, which is an earnout or some form of contingent payments. And I really, think that is a great bridge for where Anna's value, where she thinks that the value is of the company and what the market thinks, and maybe we just need to bridge a gap. And earnouts are a great instrument for bridging that gap, all things being equal. And then, of course, there's other. I'm in a deal right now where there's all three of those are included in the transaction. In addition to, it's a 12-month. The founder is going to stay on for 12 months. He'll have an employment agreement with just like a fully baked agreement with healthcare and 401k and all of that. But then there's also a carrot at the end. If everything goes well through that 12 months, there's a 5% equity kick to the that vests immediately to the parent holding company, which is a private equity group. So that is another extra added bonus that is very appealing to founders.
Okay. All right. Pavel, do you have something to add?
Yeah, I think based on our experience, if an average founder comes to say SaaS Group and kind of their expectation is for a 100% cash deal, right? Whereby you get paid at closing and then you have a customary holdback to account for indemnities and reps and warranties, usually within 12, 24 months. It's very rare that a founder will come to you and say, hey, I want to sell my business for 1 million and I also want to have an earnout. It's just like never happens. Earnouts are used to bridge the gap or the expectation between buyers and sellers. So usually the earnouts would come from us, although sometimes people tell you, hey, I want to have sort of a piece of a pie after I exit the business. That usually never happens. So you don't really get paid an earnout once you sold the business and you exit, because the expectation is that you work together with the seller, with the buyer. On the other hand, if you are selling to, let's say, a strategic buyer, more often than not, you will not get cash at closing. You may get an equity which may be valued at a very high price, Series A or B of the last round. And what it means is that if that company were to go bust, not only you would lose all of your money, but in certain countries you would even have to pay tax up front. So I had cases in France where somebody sold their company for a little bit of cash, a lot of equity, paid taxes on the equity, and then the company went bust and they couldn't recover their money. So what one of our USPs in SaaS Group is that we can actually offer 100% cash upfront without any kind of contingencies, which actually matters to a lot of buyers.
Yeah. Thank you so much, Pavel. We have one more question. What about SaaS to get business metrics? Is there any recommendation where you can find a really comprehensive data dashboard about business metrics like NDR, LTV, and other that yield not just the normal metrics?
Yeah, I think solutions like Profitwell, ChartMogul, etc., is what we see people using. But for example, for SaaS Group, we don't really need such tools. I mean, as long as we can get access to the actual payments and billing data, we would be able to recalculate those anyway. But they do help you as a founder to be able to present the KPIs kind of straight away in a nice and presentable format. Dirk, any other platforms that you've seen recently, like Kissmetrics or?
I was muted. No, I think I would have mentioned the same that you mentioned, like ChartMogul, Profitwell, Barometrics, and stuff. Some of them seem to have problems with NDR. I don't know why, but in some cases it makes sense anyway to maybe also keep track in a Google Sheet or an Excel sheet, because I mean a lot of companies have pretty dashboards and nobody looks at them. So for you as a founder, sometimes it also makes sense to have the numbers in parallel in a Google Sheet or Excel sheet to be on top of things and to regularly take a look at these numbers. But yeah, if you're looking for tools, I think The ones mentioned are good.
Kissmetrics is awesome. We know that well.
Which one?
Okay, so there is one more.
Kissmetrics.
Kissmetrics.
Okay, and yeah, I have one more question for you guys. So we at SaaS Group, for example, are talking a lot about the way to streamline the process and like how we can close the deal as soon as possible, right? So what was your shortest deal, and that's probably the best case scenario, but what is the average timeline the founder is looking at? Paul? Yeah.
Oh,
Yeah.
so we actually do lay out like the ideal timeline, and that's anywhere from like 2 to 6 months from start to finish. But again, there's so many variables, right? If it's API drop, I mean, we can trade that in a day because there's no human capital. There's just not a whole lot to it. But most of the deals that are working SaaS, for example, with employees and clients and customers and so on and so forth, I would say that is subjective, but I would say 2 to 6 months all in. If you were selling it below market, you're going to sell it quicker. If you're waiting for top value, it's going to take longer. It's pretty just common logic there. But I would say on average, I would say 3 to 4 months is what we're seeing. Would you guys agree? Yeah,
and I think it's important to differentiate between the actual diligence and kind of preparation, right? I think Paul is right. Kind of 3 to 6 months is quite reasonable. From actual exclusivity period, so from once you sign the LOI until you get your cash in the bank, the fastest at SaaS Group was probably maybe 5 weeks. And that was a situation where we actually got access to pretty much every single tool of the business. That was a company with a relatively small number of employees. It was an asset deal, which again means that you could reduce significantly the amount of diligence that you do. But you have to have a willing founder that's able to work around the clock to populate and prepare a lot of information. On the other hand, we sort of try to commit to an 8-week timeline. So generally, for a share deal with a significant amount of complexity, for as long as we get a lot of information on time. And again, if the founders and the management are not investing time in the process, that will take longer. But 8 weeks, I would say, is kind of a standard market. For anything above that, I would say that you're talking about acquisitions where perhaps the information flow is terrible, or there are a lot of issues that require a lot of negotiation, then that could spiral into 3-4 months.
I think it also depends on the buyer profile, right? I mean, at SaaS Group, M&A is our daily bread and butter, and we have a streamlined process that we are constantly improving, and so this is why it's 8 weeks, and a lot of sellers are surprised if they hear it for the first time. I think if you're selling to a strategic, it may take longer. If you're selling to someone who has never acquired a business, it may take longer. So I think it also goes back to that 2 reference calls. So if they acquired other businesses previously, talk to these founders. How was the process? How long did it take? Any fuck ups you experienced? Because I heard stories where buyers bailed out after 12 months without coming to a decision, or without closing the deal. So yeah, it sometimes can take longer than 8 weeks.
Okay, now it's definitely not for kids on YouTube, so Dirk.
You have to use that
Beeper.
Yeah.
I didn't hit the 3-second delay button. Sorry.
And by the way, just to add to what Dirk said, I like to be very mean very often when founders tell us that, hey, I just signed an LOI. Sorry, guys. After 8 weeks, I will send them an email, say, how's it going? It's like, still in discussion. After 1 month, still in discussion, right? So I would say that in the market, more often than not, people take more than 8 weeks. And I did a post about it on LinkedIn. I would say that if you are in the process with buyer and you are sharing all the information they ask for, and the process takes more than 8 weeks, that's a red flag. That means that the buyer cannot get a sufficient buy-in from the management team, or they're not sure, they've got something else. my recommendation is that unless this delay was caused by you, it's better to walk away and see what happens, because then suddenly you might realize things are moving a bit faster.
Yeah, I think that there is a 100%, and there's a true. It is a it's a diligent process that you as the founder have to maintain, and that is, don't get caught up on that number that's been presented to you and you're already spending it, and you're just kind of blinders onto those types of red flags. And it's, probably the most, saddest thing. I my job is great. I get to talk to so many fantastic people and founders and you guys, and I mean, it's amazing. But it's also, I hear a lot of these really bad stories about founders that just got dragged through the mud through unfunded funds, and they get an LOI, and then the group starts shopping it. They need to go raise capital in order to consummate that transaction. And diligence is a two-way street. You have just as much right to ask that founder, that buyer, anything you want about, validate them. Make sure you do your diligence on them, because it's happened to very smart people that just got drug out, and it's deflating, and they have to then stop. The business has suffered, their psyche has suffered. They have to go to a Zen retreat, come back refreshed, and start over again. And it's hard. So make sure that you're talking to the right group, that they're funded. And if they're not funded, what is their plan? Do they have a plan? If they don't, that's a red flag, at least an orange flagger. But you need to make sure that they have some roadmap, some idea, some way to funding. Otherwise, you might not, it doesn't matter if that number was exactly what you wanted, because it's not real until it's real.
Right. Yeah, I can see Pavel sending them devil emoji. But yeah, I know, Paul, we have to let you go. But just last question, I promise. From each one of you, can we get one piece of advice for the founders that are looking into an exit right now? Paul, let's start with you.
I would say, obviously, come talk to us. We will give you a reality check, but we'll also set you up for success. We have a process in order, and an amazing team to get you there. And if you're not ready, you can get ready, but get yourself educated. I think that is the biggest advice I can give you.
Awesome. Thanks. Pavel?
Talk to as many buyers as you can, learn about the market, get some valuation indication, and then come back to the buyer that you feel is the most appropriate to you. Because the worst thing that happens is that like what Paul said, you get dragged through the mud, and then you come out of that process bruised, and then you sort of have to postpone the decision. So know the market, meet as many people as you can, get a price from everyone, and then make a decision where to focus your attention.
Thank you. Dirk?
Yeah, I would advise founders to think about what they're really looking for in an exit or in a transaction. So we talked a lot about market timing and when is the right time to sell. I would also consider soft factors like time spent with family. You are approaching burnout or something. So it's not worth waiting for 2 years if you have serious problems or something. So I think that's what a lot of founders forget, that they're only looking for numbers and how's the current market environment and stuff. But at the end of the day, it's also important to look at yourself and think about the real reasons why you're looking to find a good new home.
Okay, awesome. I think that's a very good way to stop this, to finish this. Thank you so much for telling all this great insights. I would love to do it again. I promise to prepare the next time so that tech doesn't give up on us. And thank you everyone who was here to listen to this. I hope you enjoyed it, and it will be, of course, on YouTube, and then we'll post it on LinkedIn as well. Thank you so much.
Thanks, everyone.
Thank
you.
Take care.
Bye-bye.